So the rally we saw last week is exactly what we've been looking for. Chef's kiss, basically, mwah, signed, sealed, and stamped. But as always, we need to ask ourselves and consistently evaluate how strong was this move, can the markets continue, or is there room for a logical and reasonable pullback at this point in time? And that's exactly what we'll look to answer in today's episode of the Weekly Watchlist. But first, some housekeeping. Monday, markets are open for a half-day session closing at 1 p.m. Eastern Time, and Tuesday, markets are closed for the holiday. So happy 4th of July, of course, to everybody based in the US. I think that's about 90% of you. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So the monthly time frame chart kicks things off. What do we see here from a candle structure and location point of view? Certainly a solid green-bodied bar for the month of June, with buyers able to close at the top of the monthly range. Not a whole lot of upper or lower wick to read into, so buyers do remain firmly in control structurally. If we think about location on the bar-to-bar count, we certainly have ourselves a substantial higher low as well as a higher high. So buyers go 2 for 2 in the driver's seat here. If we think about the broader structure and location that's in play, obviously, we've broken out over this level. We know that to be the weekly ascending triangle breakout point, but on the monthly, it also becomes very clear. You could also start to classify it, of course, as a monthly inverted head and shoulders, and we are well above the neckline of that pattern. On the monthly time frame chart, we know that our overhead target is coming from this prior pivot, much closer to 450. We'll see some targets there on the daily in just a moment. I also want to share some Fibonacci perspectives with you. If we come in from the sickness low to the all-time high, we are, of course, well above the 38.2, which is technically bull flag consolidation from this perspective. If we come in with the Fibonacci's from the all-time high to the October low, then we certainly have, and we've noticed this last week and the week prior as well, we've broken out firmly over the 61.8. The more time that we can spend above that Fibonacci level, the greater the odds become that we do see the full-blown 100% retracement, aka all-time highs inbound. I'm not calling for that next month, the month after that, or even 2 or 3 months after that, but it just improves the odds that that is the destination. Let's take a look at the weekly time frame chart and see what else we can learn about the price action here. So structure and location, once again, almost very similar structurally to the monthly time frame chart, but solid green-bodied bar last week. Obviously, some of that is due to the Friday gap up. We'll get to that in just a moment. But we do have a bar-to-bar lower low, but also higher high. So this is a very classic bullish engulfing bar where the sellers did technically have an opportunity to flush underneath that prior weekly low, but instead the buyers ran away with it and obviously took out the prior week's high, producing a substantial, higher high on the bar-to-bar count, equal high to the preceding bar back here. So buyers do strike me as being in control based on the failure from the sellers underneath the prior weekly low, and obviously the very strong close at the top of the weekly range. We know that we're in a weekly uptrend. Nothing has really changed here, with higher lows consecutively stacking up and higher highs along the way as well. So on the weekly time frame chart, can we still pull back and can we still find a weekly higher low above this breakout point closer to 420? Absolutely. Nothing has really changed about that analysis. We can come in with the Fibonacci's from here up to the most recent high. Once again, the 38.2 is going to greet us there at 420 if a deeper pullback unfolds. Nothing about this structure, nothing about the monthly structure would really suggest that that is in play, but just understand that it still is a structurally significant area. Let's take a look at the anchored VWAPs on our spiders. And if we anchor to the low of March, right, this also is confluence of support right around that 420 area. Let's take a look at the high volume nodes from the volume profile. We're breaking up and away from this. So once again, just building the case still for 420 as a very reasonable and strong pullback level on the weekly time frame. And if we extrapolate this prior high volume node, we're right back at it. So when we printed the inside red bar last week, you would have thought if the sellers were going to make a stand here and try to produce a stronger pullback on the weekly time frame, that could have kicked things off. It was from a logical area, but we're already testing that structure in short proximity of time. So everything about the higher time frames right now is still incredibly bullish, and we can certainly afford higher lows. On the daily time frame chart, let's first evaluate the expected move. If you're not familiar with this study, check out the tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 448.75, and that of course implies a big time higher high here. That of course does strike me as a bullish data point. If we're contained by the lower bound of the expected move, the number is 437.95. That of course would be a higher low from here to here. Once again, a bullish data point. So expected move is definitely bullish for the shortened coming weeks worth of trade. If we're thinking about trend, higher highs and higher lows, what do do we have in store? Well, certainly lows, higher lows, higher lows, higher lows. This is now going to be cemented as a higher low confirmed on the daily time frame chart because on Friday's gap up, we of course have produced an equal high. So the trend remains up on the daily time frame chart, and we can afford a higher low pullback as long as it wants to potentially do something that looks like this. We'll talk about the gap fill reversal on the hourly chart in just a moment, but understand that the daily time frame chart is bullish, and this will not, I repeat, this will not turn into a double top until we can break underneath the neckline of the double top and usher in a brand new lower low. So no reason to be bearish on this daily time frame chart unless we break down underneath 431.75. With the equal high in place, things are certainly looking bullish. As we mentioned, on Friday, we get a gap and go. That is a bullish indication as well. Technically, there's not a whole lot of structure here. If the sellers were going to, quote, do their job, they should have closed that gap, and then the buyers could have looked for a gap fill reversal. It simply didn't happen. So sellers are not getting active in this market. Buyers are clearly in control, producing the equal high. And what can we build for a game plan as we move into the coming week's worth of trade? Once again, remember that Monday is a half day. I'm not planning on trading Monday. I feel like 90% of traders aren't anyhow. So just use Monday as a gauge to see where we may open on the Wednesday session. There's a couple of key components that I want you to be thinking about here. Obviously, rainbows and butterflies consolidation would be above 443 into the Wednesday open, The reason for that would be, obviously on Friday we get a squeeze out of the gates, we put in this bull flag consolidation, it breaks, and into the afternoon session, we do not violate that level. So there's no reason to even think about shorting the market. If we're above 443, we will look for the 444 equal high break, and the next overhead targets that we have to start scouting would be up towards the upper edge of the weekly expected move. Let me go back to the daily time frame chart and show you something interesting here. I'm going to go out and grab something like a 4-year chart just to illustrate what we're dealing with. So if I zoom in, remember that the range as the market was breaking down through 2022 was very, very aggressive. So although this doesn't look like a large range over here, if we compare that to 2023 price action, all of a sudden, this looks like a massive range in the upward direction, and even further than that, right? To get up to here, those are really large ranges to travel based on today's volatility. Remember that the VIX was extremely elevated when we were on that downdraft, where these levels are being produced from. So it's actually a little bit of a gift because the next big overhead structure leaves plenty of room for the market to move in the upward direction. So just going back to the hourly time frame chart, no reason to think about a short if we're here above 443. Breaks of 444, we've got to trade on the long side, equal high breakout, and the next overhead target is the upper edge of the expected move, 448.75, also pairing nicely with prior structure that we just saw. Now, on the downside, how would I look to get involved in this market? Certainly willing to stab shorts intraday for something that does this and the potential for a gap close. I'm not sure that I would even want to take the lower high back underneath 443 and trade scalps there in the downward direction. I would be neutral in this range, to be honest with you, just noting that we might get some sideways consolidation up here and then a break. The only short trade that I can really think of at this point in time would be to close the gap underneath us. Underneath Friday's low, 441.10, closes the gap down towards 438.30 and the lower bound of the weekly expected move, right? Something that may look like this, lower high in here, and we can start to trade for this. When and if we get to the gap fill, remember that we are, of course, looking for a gap fill reversal that produces a daily higher low here. So strong area of support. What else is providing confluence of support around that level? We can check in with the fibs. I don't think that they're all that special if we come from here to here. Not bad, not bad. I'll give a little bit of credit where credit is due. It certainly would be around the range of the 38.2, but not precise. The most important thing to really bring up here would be the intraday anchored view at breakout coming from the low of the inverted head and shoulders, because remember that was the pattern in play here. Remember that on Thursday. So even if you're not a believer in the Friday gap up, right? Think about what Thursday did. Let's rewind the clock just a little bit here. Thursday gets a break of the inverted head and shoulders neckline here, right? And then we produce a higher low above that area at 436.75. So even if you're a non-believer in the PCE gap up, structurally, Thursday was just as significant with the higher low. But all of that aside, right, the gap fill reversal is also confluence of support with the anchored view app coming from the head of the inverted head and shoulders. Where do the bears start to gain an edge? This is the only place where the bears start to gain an edge. We can trade short scalps on something that looks like this, that is fine, but for a more substantial downside edge to really emerge, bears need a lower high, not just price underneath, they need a lower high below 436.75, and clearly that's well extended through the bottom of the expected move here. If this is going to turn into a double top, as we discussed on the daily, requires a breakdown through 431.75. So based on everything we can see, Bulls on parade. Let's take a look at some supporting evidence. Exhibit A, market internals. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. One question, is this bullish or is this bearish? Certainly boils down to being bullish. Significant volume inflows on the Tuesday breakout, nearing it on the Friday and Thursday moves here. Net inflows on the week are well above positive 500 million. That does strike me as substantial. Advanced decline line gets into trend higher zone multiple times throughout the duration of the week, hardly spends any time in the bearish zone. All cumulative builds are bullish and they're sustained. None of these are overly indicative of short squeeze. The buyers look strong. Market profile is always Exhibit B. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. We're starting with a zoomed out view because I want to illustrate that the prior value area from this day way back over here, the value area low is technically spot on to Friday's low. Now, it's not to say that that strengthens Friday's low, but rather the opposite. If we were to break down underneath it, the gap close should be the intended move out of the market. It would be an indication that we are not getting price acceptance in this prior value area. There's nothing about the daily or hourly structural chart that we saw that would indicate that that's a likely move to close that gap, but I did want to point out that nuance. If we zoom in to the profile and see what unfolded on the Friday session, what you'll notice, of course, is that value, of course, migrated higher in the profile, as did the point of control. We have great excess at the lows and decent excess at the highs. This is not a P-shaped profile. It's not overly indicative of short squeeze, so I would say everything about the profile here is bullish and is indicating more acceptance of these higher prices instead of rejection. How about the performance of our sectors on the Friday session specifically, because that's when we got the gap and go. We know from the Wednesday midweek market update that obviously Tuesday was fueled by the risk on sectors, but Friday was actually fueled by the risk off sectors. Notice at the top of the list we see utilities, staples, and healthcare. Then we get something like your XLK, tech sector, discretionary, communications, financials. They're definitely lower on the list. But the question to ask yourselves is, once again, is the percentage what we care about, or do we care about the structure and leadership that's there? So let's take a tour through the structural charts. What do we see out of utilities? Any leadership issues? No, just a little rebound off of this area of support. What do we say about the D for defensive sectors, right? We do not want them falling off of a cliff, but we also don't want them leading any given market move. I don't see leadership on this chart, and I'm also seeing a great defense of this area of support. This does strike me as a bullish look, even if it was the one that led the move on Friday. Let's take a look at the XLP for consumer staples. Same kind of idea, making a stand for a possible higher low in here, but also not exhibiting leadership, rallying and leading the move in the S&P. XLV for healthcare, same exact idea, not falling off of a cliff, not exhibiting leadership, no issues. XLK, it still participated in the gap up on the Friday session, and it did have a green day. We also know that we're sitting right at basically all-time highs. We've seen a reasonable pullback. We've found ourselves a higher low off of well-documented structure from here. So with this now cemented, we will look for the equal high and then all-time highs after that. Certainly looks more risk on to me as opposed to anything else. And even just look at the weekly performance, right? The weekly percent change, 3% positive. That's nothing to really laugh about, right? Let's take a look at the XLY. Same idea. We were kind of concerned with this as a potential look above and fail, the upper wick on the Wednesday session. What happened Thursday and Friday? It is certainly breaking out of a multi-day balance, or call it a daily bull flag. This does strike me as being more bullish than bearish going forward, as long as we're above 167.25, supportive of the bull thesis. Let's take a look at the XLB for materials, really lightweight sector, but is it participating? Yes. Is it exhibiting leadership up and over these prior highs? No. What do we know about communications? This is definitely more closely tied to risk on posture. It's coming in for the equal high. It participated on the Friday session. Didn't have the strongest close on Friday. I will give the bears a little bit of a concession there. So anything that just consolidates here needs to hold the higher low above this prior range. That number is at 64.30, but overall, anything that stays here is constructive. Breakouts are obviously bullish. Coming back down underneath is not the end of the world, but it does jeopardize the breakdown of that as an area of support. XLI coming in for the all-time high test. We know that 109 is the measured move target from the double of the range here. So a little bit more room to run in the upward direction if we're truly going to hit it. We shall see, but nonetheless, this does strike me as a bullish looking chart. XLF, this is where a substantial amount of work was done. I'm really pleased with the XLF. If you recall from prior videos, we had talked about how 32.85 really needed to start showing us something one way or another. And it decided the bullish way. I mean, undoubtedly, the equal high recapture of the 200 SMA, that's the green moving average on your screen, gap and go on Friday. Thursday, really impressive move in the upward direction. This is looking fantastic. So what do we want to see out of XLF? If it's truly going to help the market overall sustain this uptrend, this new leg higher, any pullbacks need to stay above 33.30, and that of course would provide a constructive look with a higher low, and we'll look for this equal high break. To our left, if I just go like this, we understand that we have the banking crisis thin structure there. A strong move could develop if we can get up and into this area. The next major structure I could pick out was at 35.25. This type of move for the S&P, massively bullish if it does start to unfold. This structure that's boiling down here does look more bullish than bearish with the ascending triangle, higher lows, and thankfully we've resolved 32.85 higher. It's a really, really important note for the S&P here. So thank you to the financials. Let's take a look at real estate. Technically did the best on the week, 5.13%. Any issues with leadership? Is it falling off of a cliff? Nope. Okay, good to go. Next. What's going on with energy? Okay, how are we doing here? Any leadership? Absolutely not. Is it falling off of a cliff? Absolutely not. Good to go. So sectors, they're looking pretty darn good still. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. For the most part, these charts still speak for themselves. This is bullish consolidation above a clearly upward sloping 50 SMA. This is the most risk-on sector we have, supports the bull thesis. XLV is D for defensive. It does not look like a threat as it's pointing lower underneath a descending 50 SMA. I will continue to point out that financials on the ratio grid are still a red flag. This really wants to improve. It wants to get above the 50 SMA if it's going to be more helpful for the S&P. You could imagine how that might unfold if we move through the thin structure from the banking crisis. XLY looks fantastic, clear uptrend here. Closest tie to the risk-on posture is the XLC. It's definitely mellowing out and going sideways, but it's still above an upward sloping 50 SMA. No threat from a D for defensive sector, no threat from a D for defensive sector, no threat from a D for defensive sector. We know that this has much more to do with the wealth effect, and clearly based on the structural chart, it did just fine in the previous week's worth of trade. Let's take a look at the XLY over the XLP. Speaks to risk on versus risk off. Clearly, making a new higher high on the Friday session, this does agree with the risk-on sentiment. So I must have jinxed the data because it's back to giving us really funky-looking candles, but Friday was a solid red bar on the dollar. That certainly does support the move higher that we saw out of equities. As long as this stays underneath 103.50, does look more like a bullish piece of evidence to me than anything else. How does the gold contract feel about this into the end of this previous week? It's trying to produce a look below and fail on this level here at 1920. It's got to perk up and stay sideways in this range up here. You really don't want gold falling off of a cliff in the downward direction. It's not the end of the world, but if we're going to see the dollar maintain stable levels, gold probably wants to stabilize as well, not continue this downdraft here. Let's take a look at what's going on with rates. Rates actually broke out on the Thursday session. So here's Thursday, and what I would just remind you, I'm going to flip back and forth here for a second. Let's go XLK and take a look at the Thursday session in particular. Was Thursday really a big downdraft as rates went higher in the TNX? And the answer is no. That kind of speaks to a more resilient market in my mind. So if we just go back to the TNX, understanding that, sure, we might be pricing in that second rate hike into the end of this year. We'll take a look at the tracker tool in just a second, but the tech sector really didn't respond bearishly to that information. So the next stage of this chart setup would really be to determine whether or not this is just look above and fail. If we start spending the early stages of next week underneath 38.20, that to me would be a bullish indication for the tech sector, probably producing the equal high and going on to produce all-time highs beyond that. Obviously, that is a risk-on look for markets down below. Let's check in on the tracker. So we're still pricing in higher odds of a 25 basis point rate hike for the next Fed meeting, which is on July 26th upcoming. And as we know from a fundamental point of view, the big debate is 1 versus 2 rate hikes into the end of this year. And notice that even as PCE came out on Friday, we did not see an uptick here, which is what we were watching for on the Wednesday midweek market update for a possible indication of that second rate hike coming in. Remember that the current path for the market is that we get one more hike in July, then we flatline, and then we start cutting into the early stages of 2024. If this starts to show that second rate hike coming in, it's still implying that we get the current rate hike, a pause, then the rate hike, and then we pause and then start cutting into 2024 as scheduled. So watch out for that in the month of November. You're going to continue to keep an eye on services inflation. If we take a look at the PCE data that came out, we know that we hit the expectation on the month-over-month read from the core index. 0.3% was the number. That was fantastic. It led to the gap up, but I did some digging and we can take a look even further than that. If we look specifically at services inflation, you might say, Matt, we went from April a 0.1 to May a 0.2. Why didn't the market fall? Isn't services inflation the sticky inflation that we have to combat? And you're absolutely right. It is the sticky inflation that we have to really battle against, but 0.2 really isn't that far out of the norm. And don't worry, I've got more supporting evidence. Bear with me. 0.6 is what we want to avoid. 0.6 is what we want to avoid. 0.4, 0.8, these are the numbers, these are the types of reads that we want to avoid. 0.1 and 0.2 is kind of within the threshold of what we would consider normal out of services inflation. All right, so what we want to combat is if we take a look at this is housing specifically, because this is where there's an issue. There is no percentage month over month, so I've done the math for us. If we take the difference between 147.075 and then 147.835, it's technically a 0.5163% increase. I'll say that one more time, 0.5163% increase month over month out of housing specifically. Now, the Bureau of Economic Activity, which is this one here, the BEA, is not as good as reporting as what we see from the BLS, Bureau of Labor Statistics, for the CPI. So I've just flipped over to the CPI read, and if we look at shelter specifically, what was the month-over-month read for May? It was 0.6. So did we technically see a move in the right direction or the wrong direction from PCE housing inflation? It was a step in the right direction, and this is what we want to see. And Jerome Powell, if he is being data dependent, as he said he's going to be, probably has seen this and said, things are moving okay. Maybe the pause was the proper step and will continue to take in the new data. It's not an argument for what's right versus wrong, but if he's doing what he's saying he's going to do, he has made the correct steps thus far. TLT ratio to the S&P ticked lower as the move higher unfolded in equities. It speaks to a risk-on environment down below. If we take a look at the short duration bonds versus the longer duration bonds, notice that they're drifting lower. If the market was concerned about recession, these would be making new higher highs above the prior pivot tops. It's simply not the case. Once again, speaking to more risk on and favorable conditions right now. Let's take a look at the HYG. Hopefully you watched Wednesday's video, right? Hopefully you watched Wednesday's video. That's all I can say. Remember that we made the equal high into the close of Wednesday. Well, Friday, there you go, higher high, pairing beautifully with the move higher out of equities down below. So once again, confirming the more risk-on appetite down below in the market. And lastly, let's take a look at the good old digital gold. What's going on with Bitcoin? Even after the sort of BlackRock news has settled out, what do we see here? It's a bullish 3-bar play on the weekly. It was not a sell the news type of event. If this wants to break in the upward direction, would speak to more healthy risk-on appetite in the financial system as a whole. Market breadth has improved considerably with the Friday gap up. Notice that new highs versus lows made the highest impression of all of 2023, and we're certainly not risking or threatening any type of move that would look like this or this. Don't get me wrong, there is still lots of work to do to achieve the full-blown bullish look, but it is steps in the right direction, confirming the bullish nature of the move thus far. Let's take a look at the SPX A200R stocks trading above the 200 SMA in the S&P. Very nuanced higher high. The most important part about it is the fact that this held above the 50% mark for a higher low. That is a bullish indication. The one that's been giving us the most trouble recently is the SPX A50R on a daily time frame chart. Notice the strong higher high. This is certainly a bullish look considering, once again, all the trouble that it gave us through this period with the lower low as the market was breaking out. It's much more in sync with what the market is actually doing and does speak to improved bullish odds and breadth across the broad market. Let's take a look at the RSP equal weight S&P 500 ETF. You'll notice that we did also produce an equal high after finding ourselves a higher low. That does strike me as a bullish indication. It is no longer as divergent as it once was. And if we take a look at the Dow Transports, this is a concession to the bear side of the market. But remember, one data point in the web of analysis that we spin. Remember what happened last time? Transports got way far ahead of themselves here and here versus the industrials, which were unable to break out, still unable to break out, although we are sitting on the equal high. Notice that it led to a pullback in the S&P. I am not calling for a pullback here. Once again, nothing about any of the other data points that we've seen would indicate pullback here, but it is one bearish concession. It would be irresponsible of me to omit that to try to build the bull case stronger than it actually is. One data point here, Dow transports are not agreeing, or I should say industrials, are not agreeing with the breakout that's taken place thus far. It's not the end of the world. This still could break out, and we do not have a lower low, but it's something to monitor. VIX volatility remains sub 15. Just remember what we were talking about on the SPY daily time frame chart. Those overhead targets seem so wide because we were used to a VIX environment where the floor was at 2050. Now we're well below 15. It's no surprise that those ranges seem unfathomable at this point in time. So understand that from a volatility perspective. It's contracting. That is more indicative of healthy upside activity. Here's the VVIX. No big issues with this moving lower. It's not yet down below in complacency zone. It's kind of hovering beautifully in between the midpoint of that range. It's also not perked up over the 103. Let's take a look at volatility futures moving into a further contango. 9 versus 30-day VIX well underneath the zero line, further contango. The one-day VIX did perk up, but I would largely attribute that to the gap and go from the Friday session. Doesn't really strike me as a big deal just yet. Then I also want to point out to you that the skew made an interesting move here. As the breakout in the market started resuming, the skew actually came down from these really elevated reads, and now it's right back up at the equal high. Just remember out of the skew that we usually don't read into the large upper reads, but it's interesting to me that it's back up here. This speaks to 30-day tail risk. Is someone seeing something that we are not seeing in the market? I'm not sure. It's worth keeping an eye on, but once again, the reading is always much more important at the lows, not the highs. Moving along to the QQQ monthly time frame chart, what do we see here from a candle structure and location point of view? Very similar to the S&Ps, obviously with a solid green-bodied bar, closing very strongly at the top of the monthly range, speaks to bulls being in control structurally. Obviously on the location standpoint, bar to bar, we have a big-time higher low paired with a beautiful higher high. We're nowhere near this breakout point, so this is even further extended beyond what the S&P has already done, and obviously we are sitting at the target here. So is it logical that the QQQ could start pulling back off of this equal high area? Certainly would make sense to me based on the monthly time frame chart. This higher time frame perspective is useful for that information. Let's take a look at our Fibonacci fan. Obviously, we put in a sort of support point here at the 61.8. We did not violate that for the 100% retracement, and we're firmly above the 38.2. No issues from that perspective. Coming from all-time high to the October lows, we are firmly above the 61.8, very similar to the S&P. So bullish here on the higher time frames. Let's take a look at the weekly structure. What do we see here candle-wise? Obviously very similar to the S&P. A little bit more of a lower wick on this weekly bar here out of the QQQ, but nonetheless, buyers were able to close at the top of the weekly range, and we do have that engulfing nature of the bar with a lower low, but also closing at a higher high, engulfing and basically showing a failure from the sellers to really materialize underneath the inside bar, the red bar here, for a deeper pullback to unfold. Obviously, the QQQ weekly time frame chart is very much so in an uptrend with many higher lows and many higher highs along the way. This is the pie in the sky, higher high, and the QQQ can certainly afford a higher low pullback. We were kind of joking about it last time, but it's true. Hate to be that guy, but the Qs could pull back all the way on the weekly time frame chart to roughly 320 and still maintain an overall uptrend. If we go ahead and throw on our anchored view apps from the all-time high, the October low, and the March breakout from back on over here, it's way down below. Once again, much closer to 320 than anything else. If we come in from the fibs from the low to the high of this move, that's still quite a ways away at 340. That doesn't really strike me as being in play for the coming week's worth of trade. It is going to start pairing nicely with this prior resistance point in here. So keep that in mind if a larger downdraft does unfold. But once again, nothing about these charts would be overly indicative of that at this point in time. Lastly, let's take a look at the volume profile on the weekly time frame. Here is that shelf, 320 once again. We're running into this overhead high volume node. Is it logical that we could pull back here? It is, but once again, with the sweep of last week's lows in the wick of this current weekly bar, you would have had to imagine that sellers, if they were going to make a stand, it would have happened on that breakdown. It simply did not. So bullish across the board on the higher time frames. I could easily see this turning into bull flag consolidation up here, then perhaps breaking out over time when and if more market participants start coming back from summer vacations, maybe early in the fall, right? That's classically a more bullish period for markets. Daily time frame chart, once again, expected move is always up first. Notice that the lower bound of the expected move, the number is 363.07, would produce a higher low on the daily time frame chart, and the upper bound of the expected move is at 375.90 roughly, and that of course also is a higher high. So expected move is certainly bullish on the daily time frame chart. Just like the S&P, we do have a gap and go from the Friday session, but unlike the S&P, we were unable to produce the equal high here. So what does that really leave us with? A little bit more of a nuanced opportunity for a daily lower high if we immediately stuff. But let's take it on down to the hourly time frame chart and build a game plan very similar to the S&P basically, right? So you can clearly see that this consolidation was not above the morning breakout point. It was pretty much a squeeze and then sideways into the close. We'll see that on the internals in just a moment as well. If we break out over the top, the equal high is on the table. That is at 372.75. If we're consolidating in here, I wouldn't really want to touch it, but like the S&P, if we do fall underneath and into the gap, I would look for that gap to close under 367.25, closes the gap at 364.85. When and if we get here, we are certainly looking for a gap fill reversal, and just like the S&P, that would produce a daily higher low. So that's the bull case to be made here with a scalp through the gap in the downward direction. Bears, just like the S&P, only have something more firm going on if we do something like this and get some price acceptance back underneath with a lower high, 364.85. If we take out the Fibonacci's, because we have not made the 100% retracement, we don't want to come from here to here. We want to come from here to here. What you'll notice is that if I do this, here we go, the 61.8 Fibonacci has been recaptured. So the odds of the 100% retracement are increased the more time that we can spend above. But notice that the 61.8 would align beautifully with the top of the gap. If we close the gap, it's the 50% mark, and that also is worth pointing out. So confluence of support around this area. If I go ahead and throw on the anchored view app from the breakout, or I should say base of the inverted head and shoulders pattern in here, you're also getting confluence of support with that anchored view app, just building the case once again that a gap fill reversal is the primary outlook if the markets see downside first, and you're only flipping to the bear side of the market for a daily lower high if we start getting some price acceptance underneath 364.85. So if you're only going to track one number, 364.85 is key support. Breaking this, your equal high should be your next key resistance at 372.75 for the daily equal high. Let's take a look at what we can see from the market internals on the NASDAQ side of things. I would say that the inflows were not quite as substantial as what we got out of the ES. On the NASDAQ, we're looking at 600,000 as being the threshold, 600 million, not thousand, 600 million, and we only exceeded it by 66 million in the upward direction. So close, but nothing substantial, or as substantial, I should say, as the NYSE side of things. You can clearly see that the advanced decline line did not get or stay up towards trend zone at any point during the week. So a little bit more of a muted move, really, out of the NASDAQ. Same thing with the cumulative builds in the tick. Notice a couple of days here actually go negative. And once again, the afternoon session on the Friday session looks to me to be more like consolidation after a morning short squeeze. We'll actually see this more clearly out of the market profile. Let's go there now. This is a very classic P-shaped profile. Point of control and value area certainly did migrate higher with price, so that is noteworthy, but the P-shape always lends itself to being more of a short squeeze type of day. If we think about the nuances, and the reason I'm leaving this zoomed out is the value area low from the Friday session pairs beautifully with this prior high. What would that tell us? It's a mechanical level. If we break down through it, that's where I would start to look for that gap fill to start to be on the table. It's not the cleanest indication. It's not going to provide this massive flush perhaps, but it's going to start to be your heads up indication, so to speak, before actually moving into the gap range. What is the NASDAQ futures level to watch? I would use halfback and value area low, somewhere right around the range of 15,316 out of the NQ. IWM Russell 2000 and the small caps, what do we see on the monthly time frame chart? Very similar to everything else. Solid green bodied bar, recapturing the monthly 50 SMA and closing at the top of the monthly range. Structurally, buyers are in control here. On the bar to bar count, we did produce a higher low paired with a higher high. That is bullish, but nonetheless, on the monthly time frame, you can clearly see that we're still stuck very much so in this monthly balance range, not nearly as bullish as any of the other monthly charts that we've evaluated so far in today's review. If we take a look at the Fibonacci's from the sickness low to the all-time high, we're still underneath the 38.2. This continues to be an issue on the higher time frames out of small caps. And remembering that small caps act as a risk-on versus risk-off proxy, it's not really giving you a warm and fuzzy feeling inside about bullish outcomes. Let's take a look with the Fibonacci's from the all-time high down to the October lows, and you'll notice that we're underneath the 38.2, technically putting in beautiful bear flag consolidation on a monthly time frame chart. Now, don't get me wrong, the monthly bar and structure that's formed here is not overly bearish. It doesn't look like we're threatening a breakdown of the flag yet, but I'm just pointing out that it's not nearly as bullish as the other indexes that we've evaluated so far in today's episode. Let's take a look at the weekly time frame chart. What do we see here structure-wise? Certainly a solid-bodied green bar, closing back up towards the equal highs. Very nuanced, but technically they're higher low on the table from the weekly time frame. And certainly the most important part about this chart is the fact that we have found ourselves a weekly higher low. That can be cemented with the equal high that was produced into the close with the Friday gap up. We'll talk about the daily chart in just a moment, but before we go there, let's take a look with our anchored view apps from the bottom out of the IWM. Much more relevant, clearly, right? We're getting a little bit of a pinch between the all-time high anchored view app and the October low anchored view app. You've really got to resolve this area for a firmer move to unfold out of small caps. Obviously, if we can breach it in the upward direction, which looks decent right now with the weekly higher low that's formed, holding this lower anchored view app as support, 200 would become the target, and that would bring us to the top of the monthly range from there. Obviously, we would like to exceed that in a picture-perfect world. So not all the way there yet, but certainly some small and minor improvements on the higher time frames. Let's move it on down to a daily time frame chart and go ahead and throw on our studies and levels here. What can we see on the daily time frame? Once again, there's your weekly range. There's the higher low that was produced. The most impressive part about the IWM and small cap weekly move that happened on the week basically is the fact that it did not get rejected on the retest of 184.75. You can clearly make the case how this easily could have turned into a big time daily lower high, and that would have cemented a more risk off look for markets. The fact that that did not happen does strike me as the biggest sort of takeaway from this week's worth of trade. Another difference here out of IWM is the fact that on Friday it was not a gap and go, it was a gap and fade. Is that warranted? Probably. We were well extended through the upper bound of the expected move, and we were gapping into overhead resistance here. Doesn't really strike me as all that surprising that markets wanted to back off from that level, but nonetheless it doesn't leave us with a gap fill reversal area on the daily or even hourly time frame chart. Let's take a look at the hourly and see what else we can learn about the chart from this perspective. You can clearly see some single prints, and we'll get this on the market profile in just a moment as well. As long as we can consolidate above 185.85 on IWM, it's looking more bullish than bearish, obviously. You could start to consider this a pie in the sky inverted head and shoulders. You could even make the argument that if we flush the lows there to unlock the single prints, it's still bullish with a daily opportunity for a higher low above the 184.75. So key inflection point out of IWM and smalls this week will be 184.75, and obviously upside wants to either consolidate and cool off, digest this overall move up here, or get further breakout in the upward direction. Next overhead target is going to be much closer to 190 in the upward direction. Let's take a look at the anchored view app, because that of course will be important as well, coming from the bottom of this move over here. Notice that it's going to start pairing nicely with the single print area, not necessarily a gap fill reversal area, so that's what I would be monitoring from that perspective. And do the fibs agree with this? Let's come in from the low up to the high here. Pretty much spot on the money with the 38.2. Good to go from that perspective. Let's see what we can learn from the internals out of the Russell side of things. Once again, not even close to substantial inflows on the week as this move higher has unfolded. So if there's any place to look for a pullback, I would say that the Russell's the weakest, the Qs are the next weakest, and then the spiders are obviously the strongest of the broad market indexes as of right now. You can clearly see the same illustration out of the advanced decline line being weak and never spending any time up here in trend higher zone. Cumulative ticks are mixed on the day. One thing that I will say is impressive is that the Thursday cumulative tick supports the idea that there was a bullish move on Thursday specifically. So note the cumulative build and note the move here in the advanced decline line. Thursday is probably the most bullish day for the Russell. If we go back to the hourly time frame chart, that's where this move really unfolded, right? So it's supporting the idea that, yeah, on the one day where the most progress was made, it was the healthiest of the days, so to speak, in the upward direction. Let's take a look at the market profile. Anything to glean from this normal shaped profile here? I would say that the point of control is obviously weaker and lower in the profile there. Value area is smack in the midpoint of that range, and you just want to be mindful of your single prints. We talked about the IWM IWM number. In the Russell futures, it's going to be 1880, 1890. Let's round off there. 1890 is the downside. Apple kicks off the core list of companies, and man, oh man, this never gets old. The new all-time highs, blue sky territory is up ahead, whole and half dollars, any intraday levels that form. Gap and go from Friday. Gap close is going to be under 190, 125, closes to 190 even, with still the opportunity for a daily higher low anywhere over 186.65. No issues with this chart. Continue to play it in the upward direction. No shorts whatsoever out of Apple. Taking a look at Netflix, what do we see here? Certainly an opportunity for the double top. People will be throwing that one at us all week long, but just remember, it's not a double top until it is, meaning that we break underneath the neckline. Does not look like a threat based on the daily time frame here. Let's take a look at the hourly chart. What else can we glean about Netflix? I'm really impressed with the consolidation that held well above 436.75 into the afternoon on Friday. You could make the case that any continued higher lows above trade to the equal high up here at 446.50, and then breakouts start to test the bottom of an overhead gap from an earnings cycle at 457.75. That's your upside out of Netflix. Where would I trade it short? Perhaps on a lower high back down in here for a look above and fail on this range. So watch 436.75 as your main inflection point. What's going on with Tesla and Mr. Musk's rocket ship headed to the moon here? Still dealing with now the inverted head and shoulders with a lack of really follow through on Friday, up and over the 262.50. So I'd be open to the idea that this does still have some room to run in the upward direction. We've just got to see the proof with some kind of momentum. Could take a headline to spur it, could take some catalyst, but nonetheless, 262.50, if we're above it, no reason to be thinking short out of Tesla. If we start to get underneath, I would only short Tesla with a lower high below 258.75. Anything other than that, you're just kind of gambling in this choppy range as it tries to resolve the inverted head and shoulders. Let's take a look at Google. What's going on with this one? I will remain cautious and patient overall out of Google. Note the daily inverted hammer, and it is technically below the overhead supply. That level is 122. As long as we're underneath that, I'm still kind of looking for this out of the daily time frame. Then the attractive downside range to really trade for is under 116.50, gets down towards 109.25. You can clearly see that from back here. Doesn't look to be a threat immediately in the upcoming week's worth of trade, so really just watching this to resolve and really provide more of a setup. If it does rally first, I'm interested on the hourly time frame chart to see what the reaction is here off of 122. If we reverse off of it, I would definitely at least make the attempt to try to pick off a short at that level. The only time to get bullish on Google is a higher low, definitively proving that thesis wrong, and we will change our tone after that. What's going on with Metaverse and Zuckerberg's fantasy land over here? Certainly 4 equal highs have been tested yet again on the Friday session. So now 5 equal highs back to back. Ideal rainbows and butterflies consolidation is over 286.50. Breakout is over 289.60 for follow through to continue to close the gap way up there at 307.50. Lots of overhead room to run. You don't need to be the first one in the door. You could wait for a break, retest, and higher low above this level, and then watch for the continuation in the upward direction. It's already proven to us that it doesn't want to look above and fail once or twice, I should say. I'm not sure I would trust it on the third time. At this point, definitely leaning more bullish for that break, but if we do come back down into range, I would have to be neutral in that area and not nearly as bullish biased. Let's take a look at NVIDIA, what's going on with NVDA, breaking the inside bar sequence. Let's go to the daily chart to illustrate that. So we know that this red bar acts as the container, inside, 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 broke out of that on the Friday session. That does strike me as a substantial improvement. I like the consolidation that's happening over the 421 level. As long as we can hold up above that, looking for the rotations into 436.50 for the completion of that move. Anything that does provide a lower high back down underneath, you might want to trade towards the midpoint at 411.25, but not convinced with the start of this break and the bullish consolidation into the close on Friday. Let's take a look at Softy. What's going on with Microsoft? Strong squeeze. Remember, this is now turning into an inverted head and shoulders, much more closely linked to the activity that we see going on with Tesla, for example. So looking to trade this in the upward direction. Big retest here is at 345.50. That's the overhead target. Any higher lows basically over the 338 at this point are bullish and good to go. If we fall down underneath the level, I would just treat this as choppy and consolidation, noting that you are technically getting a string of daily higher lows perhaps. The only short is a lower high below 334.25 at this point. Last but not least, the mini beast. What's going on with Amazon? Balance range in place. Let's go to the daily here to see this. You can see a couple of upper wicks, just almost like Meta actually, testing the same exact level. We do have an overhead gap to close at 131.30, closes at 134. That's your upside. Once again, I would start to favor this one in the upward direction. Multiple attempts to get price acceptance under underneath this as overhead supply just absolutely gobbled up and denied on the Friday session. So watching for more of a bullish outlook here, bears only have something going on with a lower high below 127. Trade ideas, and then you're on your way. First up is AMAT for Applied Materials. Multiple inside bars on the Wednesday, Thursday, Friday session, looking for a break up and over 145.36 for continuation into new highs here, or at least local new highs. If we take out the bottom of this pattern at 142.82, not necessarily as interested. Here it is on the hourly time frame chart. You could certainly start to classify it as a bull flag here. Once again, 145.36 in the upward direction for your upside. Next, last but not least, for the full video is going to be on JP Morgan. Really constructive look out of this chart. It's been building a base. Here's the banking crisis from back on over in March. It put in this flag consolidation, never resolved. Obviously, the gap up from earnings cemented the move, or at least stopped financials from bleeding out. And now it's breaking out over this big time high, right? So if we can get acceptance above, what's the number here, at 144. As long as we can accept above 144, looking to trade JP Morgan in the upward direction on a massive ascending triangle breakout. The measured move is technically this distance right here. It's a bit optimistic, obviously, into the coming week's worth of trade, which is a shortened week's worth of trade. But over time, you can clearly make the case that JP Morgan should be thought of in more of a bullish tone instead of a bearish tone. If it does turn into a look above and fail, that's fine. Only looking for shorts, not on the break back down through, but confirmation after a lower high below that 144 level. With that said, that's going to wrap up today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. All the US residents, I wish you a happy 4th of July. Enjoy the long weekend. Spend some time away from the screens. Friends, family, good food, barbecues, all that good stuff. With that said, I wish you a green trading week.